The uptrend in the S&P 500 cannot be stopped. Since the low in March 2026, the market has essentially known only one direction, and that is upward. While the momentum is slowing down, we can clearly see on the 4-hour chart that the overarching trend is still absolutely intact. My name is Oliver Sparring, and I warmly welcome you once again this week to our Level of Interest Market Briefing. Today is our first episode in June 26. In this format, we look at the S&P 500 together and examine what awaits us over the course of the week and, above all, on today's trading day. In doing so, I'll show you in practice how we use our market analysis software Level of Interest, how we use it to find suitable locations for good trade entries, and how we use it to plan ahead for today's intraday trading day. It is June, and so one or two of you might already think that the summer lull is on the horizon, but that is actually not the case. On the contrary, a stronger long seasonality still lies ahead of us in the coming weeks before the vacation season actually begins and the market falls into its typical summer lull. As far as seasonality is concerned, our software Futures Insights 2.0 shows us that from a statistical point of view, we could still have a few nice days in the uptrend ahead of us. A look at our stock market traffic light, which you can find for free on our German website TradeNeon-academy.com, also shows us that the market is in an absolutely healthy state. Only a few individual indicators point to a correction coming soon. The most prominent among them is the McClellan Summation Index, which gives us information about market breadth. The uptrend is being carried by a few heavyweights in the index, while the broad mass is already weakening somewhat. This would also explain the somewhat flattening momentum in the uptrend at this point. All in all, the overall market is in a still absolutely green zone. In terms of news, quite a bit lies ahead of us for this week. We have economic data being released every day. Today at 9:45 a.m. Eastern Standard Time, we need to prepare for the S&P Global Manufacturing PMI data. A quarter of an hour later, we then also get the ISM Manufacturing PMI and ISM Manufacturing Prices data. In terms of earnings, it is rather quiet this week. Only a few real heavyweights are releasing their figures this week. The most prominent player here is probably Broadcom on Wednesday, because we know how strongly the AI and semiconductor sector is currently influencing the markets. Let's jump into the 5-minute chart and take a look at our analysis for today. On Friday, the market moved extremely quietly and in a range. Accordingly, quite a bit of institutional pivot points have accumulated in the price range between 7,584 and 7,612 points in the ES future. A look at the price action of the overnight session shows us that the market is picking up where it left off and is already trading above the previous day's high at the current point in time. So, we see no reason not to remain bullishly positioned at the current point in time and to look primarily for long trades at our levels. We therefore use the market's pullbacks, for example, to the previous day's high or to this triple confirmed level here at 7,595 points to look for suitable entries into a long trade there. Here we are dealing with an important reference level. We have not only the VWAP closing price of the previous day, that is of last Friday, but also two dealer hedging levels. The market makers of the options markets will therefore provide liquidity here, which will very likely lead to a stronger reaction at this level. However, it would make things easier for us if the ES were to break above 7,620, above this liquidity level here. In that case, a nice pullback would present itself to take a longer trade up to 7,640. Here lies not only a bearish-looking dealer hedging level, but also the expected move of the day. Accordingly, this zone lends itself to realizing profits. I would not trade against the momentum and look for a short trade here. Before each session, consider on which side you see the greater advantages and how you align your daily bias. Please also remember that level of interest merely reveals to you where institutional interest is located in the market. However, it is not advisable to simply place limit orders at the levels and hope for the best there. Level of interest tells us where we want to trade and in which direction. It can also reveal to us price ranges where institutional interest prevails very closely next to one another and where it is accordingly not necessarily worthwhile to enter trades. The levels must, however, still be combined with statistically tested and sensible setups from the order flow in order to build profitable trading systems out of them. Should no sudden news come in that turns market events on their head and could change the current regime, then at today's state of information, I would concentrate on long trades today, given the current situation. However, should the market manage to fall below 7,584, I would slowly become cautious and would wait. Here it can be helpful to look at the market net flow or other external data such as the dealer hedging regime from Volend. With the current data situation, we see larger exposure bars at 7,580 as the lower boundary and 7,650 at the top. Please mind, those are prices from the SPX, not the ES future. I would keep a close eye on these levels because they can be turning points in the chart. But note that the data situation can change significantly after the opening of the US trading session. For me, the data from Volend is one of the most essential factors that helps shape my bias in the intraday context. I always have Volend running next to my chart and keep a close eye on the data. The option dealers, that is, the market makers from the options markets, now account for over a third of the entire trading activity in the S&P 500 and thereby take a large influence on the price. Ignoring this data would therefore be almost criminal. If you would like to try out Volend, you'll find a code in the description below with which you will get 10% off the subscription in the first 6 months of your membership. By the way, we are currently working on a comprehensive online course that clearly and understandably explains the entire dealer hedging phenomenon and shows you how we work with this data in daily practice. That's it for this week. I hope you enjoyed our brief market overview, and I look forward to being able to welcome you again next Monday. Until then, take care and successful trades. If you would like to test level of interest, you'll find further information about it on our homepage TradeNeon.com. Register and you can test the software free of charge for 7 days. See you next week.